What's going on, y'all? Welcome to another edition of Weeds Weekly, where I, Kevin Weedmark, take you through all things that happened this past week. This upcoming week, we're going to talk about think government. I think it's really important. I know I bashed the government quite a bit, but when it comes to loans and it comes to the timing of the current market, I think we need to think government. And now is the time. And what am I talking about on that? I'm talking about using the bank's money. It's kind of the perfect storm to do so. So let's dive into what happened this past week. And this past week, the biggest news was FED Chairman Powell and his message of the time has come for a change in policy. And bravo, Mr. Powell. It only took you to August with an upcoming September meeting to give us what we wanted to hear now for all of 2024, right? We've been waiting for this moment when the Fed is actually acknowledging that the time now for policy change is here. He's ready. Inflation, as we've talked about before, seems to be under control. The labor market seems to be struggling a little. He is ready, and that's the biggest thing that happened this past week. The other thing is the markets could care less. We had a job revision that came out, and what it is, it's basically a revision that went from March of 2023 to March of 2024. And what it found is that we were off by 68,000 jobs a month. They were overreported. The labor market looked better than it did. But what was amazing to me is the market could care less. The bond market had very little reaction. The stock market had very little reaction. And the reason behind that is simple. When you really digest it and think about it, is this. The market's forward thinking. Where we are today has already been established. So they're not overly concerned, especially with data that is a year group of data, but it's already 6 months old. It's old data. So where if it was present and it was the 12 months back from where we currently are, I think it would have more of an impact. But given that we've had that 6 month lag, nobody seems to care. And the other good news was housing seems to be a little bit back on track, from existing home sales to new home sales. New home sales actually exploded last month. They were up over 10%. But from a home sales perspective, even existing and building permits, which was good, it all came in higher than forecasted. So that was a great thing for the housing market. It shows that we're not terribly underwater, but again, we are in the summer months, right? Across the board, really on a national level, this is a really, really, really good time to buy a home. That fall season into summer, before school, it's a great time for the housing market. So look, it's great to see it rebounding, but it's got a long way to go. So what do we have this upcoming week? And although it's a little bit of a slow week, what we do have is on Friday, we have PCE. PCE is one of the biggest indicators that the Fed looks at for its inflationary gauge. And I'm pretty sure what we're going to see is what we have been seeing. We're going to see that inflation continues to come down. I think we're going to see it as a slow drip that we have. Inflation seems to be lagging behind everything else. The price of both consumables and services still are elevated. They came in at 2.8%. I believe that's what the forecast is for this go around as well. But maybe we get 2.7. I think we were at 2.9. Again, the Fed wants to get it down to 2%, but we're moving in the right direction, and a September rate cut is right around the corner. And the other thing is, hey, is the summer affair over? I've been talking about it a lot. I think the consumer is under tremendous pressure. If I look at all the data from, consumer debt data, the pricing at grocery stores, what inflation is doing with insurance, what inflation is doing with gas, just the normal consumables for the average American, I believe they're truly struggling. But consumer confidence seems to be pointing in another direction this past month. And I expect a little bit more of the same, right? We got an anticipated rate cut. I know the election typically puts angst in us, but it seems like it's not such a battle yet. I think those months are coming where we're going to get a lot of negative advertising and stuff like that. I think the heat of it is coming. But right now we seem to be in a good spot. So we do have a read of what the consumer is thinking, and consumer confidence comes out this week as well. And also we have initial jobless claims. That will be another big thing that is constantly being looked at by the Fed. And what they're looking for is, do they do a quarter point in September, or are they going to get really aggressive with a half a point? Look, the Fed has clearly said his message, the time has come for policy change. They're doing something in September. The market is already baked in. We're at a 50-50 quarter point or a 50 point rate cut. And it's all going to come down to the labor numbers. Inflation's going to be in tune with the PCE this week. And then next week on Friday, we're going to get that Nonfarm payroll number as well as the unemployment number. And that will be the dictator of what the Fed's going to do for September 18th. So let's dive in real quick. And I want to talk about FHA. First-time home buyers seem to be one of the most active groups in the marketplace today. A lot of pent-up demand in that market. And those individuals that are first-time home buyers, payment is critical for them. So any movement in interest rate, any movement in pricing is going to be something that they're going to jump on. And as we've said here numerous times, we're sitting in kind of the perfect storm. We got a lot of inventory, right, in certain parts of the country. We got interest rates are going to be coming down, and we have sellers that are willing to negotiate. So I wanted to just address really quick, think government. Often we think about, hey, somebody needs 20% down and all that. But when you're working with your first-time home buyer, or it could even be your second-time home buyer, somebody that has a loan amount that is going to be less than $498,257, that is a big loan amount. So you could get somebody purchasing a $600,000 home, and if they're putting down 20%, they could consider an FHA loan, although they probably wouldn't. But again, you have people that don't have a lot of cash flow, make a lot of money, but they don't necessarily have a lot in a nest egg to go purchase a home. Could be their first home or second home. The FHA is a perfect program for them. So I wanted to highlight it really quick as we're out there, right? The down payment's only 3.5%. That is huge. That is all the money that you could possibly need to come to closing with. Seller concessions, even at 3.5% down, are up to 6%. On a conforming, if you're less than 10% down, you're 3%, 10 to 25% down, you can go 6%, 25% down, you can go 9% on a conforming loan. But the bottom line is there's no program that's better. 6% seller concessions, 3.5% down. It's an amazing program. Credit scores can go all the way down to 580. Also, they really will bend on DTI. I just got somebody qualified up to 55% back-end debt ratio, and that was due to their credit being extraordinary. But 55%, I couldn't get them qualified on conforming, but I got them qualified under FHA. Something to note. So the point there is, if you're working with somebody and your clients are working with somebody, make sure that they're exhausting all their options. I get somebody may come to me and say, hey, I want to put down 10% and this is what I have and so on and so forth. But once I get talking with them and they realize, well, I don't need just the 10%, I need all the closing costs and everything else, often then I will talk about the FHA program. Because again, it's a cash flow issue. So if you're working with somebody, your clients are working with somebody, make sure that they're exhausting all loan programs available to them and going through the numbers, because the numbers won't lie. The other thing that we can talk about is FHA offers a streamlined refinance. And with rates anticipated to drop like they are, everyone's going to be looking to refinance, correct? And what a streamlined refinance does, that allows for no appraisal. They take escrows, they swap them over right into the new loan. So from a cash flow perspective, it's really squeaky clean. You show that you currently have an income and you're off to the races. FHA Streamlined, it is an amazing program. They make it as simple as possible. And you don't have to pay that FHA funding fee again. Not on a streamlined refinance. It's not that you pay it again. You've already put it into the system. So it's really amazing for those clients that are just looking to lower their payment very quickly. And the last thing, and we talk about it today, is it's an assumable loan. So it might not be as pertinent as maybe 2.5 years ago when you were locking in rates in the 2%, but there's always somebody out there that if you're a seller, there's already somebody out there, there you go, there's already somebody out there that is looking possibly that they can't necessarily qualify for a slightly higher interest rate because of credit, but you can get them into your home under an assumable because you have a lower interest rate. So that's something to consider. And the last thing I wanted to cover is now this is the time. I cut a live Instagram every Thursday with a great real estate agent, Jennifer Goodman. It's called What's Brewing, and I talked about this on that program, so I thought I would address it here. And right now it's the perfect storm to use the bank's money. And what do I mean by that? And it's going to take me a minute to explain it. And if you have a question for a client, please don't hesitate to reach out, because sometimes it can get a little bit confusing. But when I say now is the time, is we can all agree that interest rates are going to be lower in the future, whether it's the later part of this year, whether it's 2025 or early 2026. Rates are going to be lower. So, things to remember. When you're purchasing a home, one thing is we all get paid, loan officers, brokers, doesn't matter if you're a banker, we all get paid by yield spread. So that yield spread can range anywhere from, let's use an example of minus 4%, where you're buying down your interest rate, all the way to 3.627, something crazy, a crazy number. And let's remember that with the interest rates coming down, if you have the ability to qualify for a higher interest rate, so let's say the going rate is 6.5%, but I say to you, hey, if I could give you 7% and you qualify, the bank, the yield, because I've already told you, right, you need to work with somebody like myself that's going to be extremely transparent, that is going to share a rate sheet so that you know exactly what's going on. So if you have a loan amount and I say to you, I'm willing to make a point, but the bank is paying us 3.6275 or something like that, or 3%, that's going to give you that 2% to 2.5% back to you at closing to use towards closing costs. It can fund escrows. It can pay your homeowner's insurance, that you have to pay for a year. It can pay those closing costs of the title company. And essentially what I'm saying is it is free money. Yes, you have to qualify for that higher interest rate. Yes, instead of saying 6.5%, you're paying 7%. That payment could be anywhere from $100 to $200 more. But you're only going to have to stay in that loan for about 6 or 7 months. The bank only requires you, I'll repeat it, to stay in that loan for 6 or 7 months. So if I could give you upwards of $10,000 back to shove into an escrow account to pay for insurance, and the payment is only going to increase by, let's even say it's $200 a month, you're in it for 6 months, that's $1,200. If I was able to give you $12,000 at closing, you have $10,800 at your disposal. That's your money. That's basically free money that the bank is willing to give you because you qualified for a higher interest rate. Trust me when I tell you, it's one of the most amazing things out there that allows you to fund escrows, to pay for things at closing that you don't have. And again, it is a way to use the bank's money to your advantage and to fund escrow accounts. So then on that refinance in 6 months, when the rates are lower, and you only want to do this now when we anticipate that rates are going to be lower and on a purchase, is that you're going to be refinancing anyway. So why take the lowest rate if you qualify for the higher rate? Use the bank's money to get to the closing table, to pay those costs, to fund your escrows, knowing that the lower interest rates are coming and you're going to be refinancing anyway. I get it. It's a tough concept to understand, but when you sit down and you look at it on paper, it is a great program. And that's why people come to me, and that's why I've been doing business with people for so many years, over 20 years now, because I think outside the box. I'm transparent as you can be, and I'm always trying to think of creative ways, because my biggest goal for all my clients, whether it's your client, my client, whatever the case may be, is to save them money, whether it's through cost, like we just talked about, using the bank's money, or it's the lowest interest rate possible, because I'm willing to make less and and offer a better interest rate to the client. All right, everybody, have a great week. As you can tell, I am sitting in downtown Saratoga, New York. So it's a beautiful night here. I'm not sweating bullets as I sit here and do this. So I'm clearly not in Austin, Texas. But I hope everyone has a great week. I'm working as always. Pumped out a bunch of pre-approvals this past week. I got 4 loans that I locked in today. So I'm working. If you need anything, please do not hesitate to give me a call, a flyer, run a loan scenario, think outside the box, get creative for a house that you have for sale. I'm your guy, and I would love to talk to you sooner rather than later. All right, y'all, have a great week. Happy selling out there. Cheers.